You've got $100,000 to invest. Now comes the real question. Where do you put it? Two of the biggest contenders are SCHD and VTI, but these ETFs play completely different games. One is all about dividends and passive income, while the other is a set it and forget it total market beast. So which one actually makes you more money, and which one fits your investment style best? In this video, I'll show you and John the differences between these two ETFs, covering their strategies for generating returns and the potential risks involved. Each aspect will be broken down to give you a clear understanding of which ETF might better suit your investment goals. And in the end, I'll show you and John a side-by-side comparison of investing $100,000 in each ETF over the long term. One ETF is a clear winner and has the potential to reach an over $4 million valuation. Let's start by understanding exactly what these ETFs are built for. SCHD and VTI might both be ETFs, but their strategies couldn't be more different. One focuses on steady income and dividend growth, while the other casts a wide net over the entire US stock market, capturing everything from small startups to trillion-dollar giants. If you're looking for a fund that pays you consistent cash flow, SCHD is built exactly for that. It prioritizes high-quality dividend stocks, meaning companies with a long history of reliable payouts and strong fundamentals. On the other hand, VTI doesn't care about dividends. It's all about owning a piece of the entire U.S. economy. If it's listed on the stock market, VTI owns it. That means you get exposure to high-growth tech stocks, industrial powerhouses, financial giants, and even small-cap companies flying under the radar. The real difference comes down to how these ETFs grow your money. SCHD grows through dividends and share price appreciation, but its biggest strength is that it pays you along the way. Every quarter, those dividend payments hit your account, and if you reinvest them, you supercharge your compounding returns. VTI, on the other hand, takes a long-term growth approach. It doesn't focus on dividends because most of its holdings, especially tech companies, are reinvesting their profits instead of paying them out. The upside? Higher growth potential. The downside? You don't get paid much in dividends, so you're relying purely on stock price appreciation. If you're the type of investor who likes to see cash flow regularly, SCHD might feel more rewarding. There's something satisfying about watching your dividend income increase year after year, knowing that even during market downturns, you're still getting paid. But if you're thinking ultra-long term and want to maximize overall returns, VTI's broad exposure gives it an edge. It captures every sector, every industry, and every market movement, making it one of the most reliable ways to passively build wealth over decades. But just knowing how these ETFs operate isn't enough. To really understand their strengths, you need to look inside and see exactly what they own. Let's break that down next. To understand how SCHD and VTI actually make you money, you need to look at what's inside them, because at the end of the day, an ETF is just a basket of stocks, and the companies inside that basket determine how it performs. SCHD is built for dividend lovers. It holds a concentrated portfolio of just over 100 stocks, handpicked for their strong dividend history. You're not getting high-risk, high-reward growth plays here. Instead, you get well-established companies that consistently generate cash and share it with investors. It leans heavily into financials, healthcare, and consumer defensive stocks, meaning a lot of its money is in banks, pharmaceutical giants, and companies selling everyday necessities. Companies like Pfizer, AbbVie, BlackRock, and Coca-Cola, brands that have been around for decades and aren't going anywhere. These companies are cash machines. Even when the economy slows down, people still need medicine, banking, and groceries, making SCHD's portfolio more resilient during downturns. VTI, on the other hand, is a completely different beast. It doesn't care about dividends. It's designed to own everything in the stock market. Big companies, small companies, growth stocks, value stocks, you name it, VTI owns a piece of it. Right now, it holds a staggering 3,612 stocks, giving it exposure to every sector imaginable. But here's the thing, almost a third of VTI is in technology stocks. That means companies like Apple, Microsoft, Nvidia, and Amazon are pulling most of the weight when it comes to performance. While this concentration in tech has been a blessing over the past decade, it also makes VTI more sensitive to market swings, especially when high-growth stocks take a hit. This is where you start seeing the fundamental trade-off. SCHD focuses on quality over quantity, narrowing its holdings to proven companies that deliver consistent cash flow. VTI, on the other hand, spreads its bets across the entire market, meaning it catches both the biggest winners and the biggest losers. If tech continues to dominate, VTI benefits massively, but if the market crashes, VTI takes the full impact, while SCHD's dividend-heavy approach provides a buffer. The question is, do you want a focused list of steady dividend payers or broad market exposure? This choice will impact your investment's performance. Let's see how these ETFs have stacked up historically. At this point, you know how SCHD and VTI are built, but here's the real question. Which one actually makes you more money? To answer that, let's look at their historical performance. Over the past year, SCHD returned 8.88%, while VTI crushed it with 21.47%. That's not surprising. 2024 was a strong year for the stock market, and VTI's heavy exposure to tech stocks gave it a big advantage. But short-term performance doesn't tell the full story. If we zoom out to 5 years, SCHD has gained 45.74%, while VTI is sitting at 79.69%. And over the past 10 years, SCHD has doubled investor money with a 104.37% return. But VTI has absolutely dominated with 178.77% growth. Now, in the end, I will show other factors of these ETFs that can significantly impact the final value, resulting in a difference of $4 million and over $350,000 in annual dividends. At first glance, it might seem like a no-brainer. VTI wins here. But hold on. These numbers don't include dividends, and that's where SCHD makes up serious ground. VTI's total return comes mostly from stock price appreciation, meaning you only make money if the share price goes up. SCHD, on the other hand, keeps paying out dividends along the way, and if you reinvest those dividends, your total return skyrockets. This is the key difference. SCHD is playing a slow and steady compounding game, while VTI is riding market trends and high-growth companies. But past performance isn't everything. What really matters is how these ETFs behave over decades, through market crashes, bull runs, and everything in between. SCHD's lower volatility means it tends to hold up better when the stock market takes a hit, while VTI sees bigger swings in both directions. When things are good, VTI soars. When things are bad, it falls harder. Here's where things get interesting. If you're a dividend investor, you probably prefer the idea of getting paid without selling shares. If you're a growth investor, you might not care about dividends at all. You just want the highest possible return. But what if you could actually compare these two strategies side by side? What if you could see exactly how much money each ETF generates over the next 30 years? Well, we did the math, and the results might completely change how you think about investing. That brings us to the next big question. What happens when we actually compare a $100,000 investment in both ETFs over 30 years? Let's run the numbers and see which one comes out on top. Starting with VTI, the Vanguard Total Stock Market ETF. It has a 1.24% dividend yield, which is pretty low, but that's because most of its companies reinvest profits for growth. It also has a 6.99% dividend growth rate and an average annual share price appreciation of 10.88%, which is strong long-term growth. Based on these metrics, if you or John invest $100,000 in this ETF, after 1 year, it'll grow to $112,120. Decent, but not life-changing. After 10 years, things start to accelerate, reaching $308,482. By 20 years, your investment will be valued at $922,938, closing in on that $1 million mark. And after 30 years, VTI's compounding power takes over, bringing your portfolio to $2,704,940. After 30 years, VTI is only paying $9,539 per year in dividends, or about $795 per month. It's not enough to live on, but that's not what VTI is designed for. It's built for capital appreciation, and most of its returns come from share price growth. Now let's compare that to SCHD, the Schwab U.S. Dividend Equity ETF. Right out of the gate, SCHD has a 3.59% dividend yield, nearly 3 times higher than VTI's. It also has a stronger dividend growth rate of 11.04%, which means those payouts increase significantly over time. However, SCHD's share price appreciation is a bit lower at 7.69% per year, meaning it doesn't grow as aggressively in stock price alone. Based on these metrics, after 1 year, $100,000 in SCHD would turn into $111,280, just slightly behind VTI. After 10 years, it'll grow to $307,048, keeping pace. But after 20 years, SCHD's compounding dividends start pulling ahead, pushing the portfolio to $1,089,682, crossing 7 figures sooner than VTI. By 30 years, SCHD blows past VTI with a total value of $4,713,336. That's nearly $2 million more than VTI's final balance. And here's where and why SCHD completely dominates: dividends. After 30 years, SCHD generates a massive $375,967 per year in dividends, which breaks down to an insane $31,331 per month. That's more than what many people make at their full-time job. And the best part? You don't have to sell a single share. Looking at the total value added, VTI's $100,000 investment grows by $2,604,940. while SCHD grows by $4,613,336, nearly double the wealth creation. VTI wins in pure capital appreciation at $2,479,580, but SCHD more than makes up for it by reinvesting dividends, adding $2,309,119 to the portfolio. So what does all this mean? If you're investing purely for long-term growth, VTI is still a solid choice, but if you want to build both wealth and massive passive income, SCHD is the clear winner. Want to know which is better between QQQ and QQQM? Click the video on the screen to find out which one can outperform SCHD by $8 million.